So I think we can now start. We have a couple of people with whom we can start today's session. So as you all see, this webinar is for making a full and an informed use of your money which you're earning, right? We most of us are living from paycheck to paycheck, in the sense that our salaries are sole source of income, and we get a credit once in a month in our bank accounts, and rest for the entire month we are probably getting auto debits in our account in form of our expenses or SIPs or EMIs or any other form of investments that we have done, right? So the entire focus of the webinar would be on this aspect, that how to create more wealth, how to create passive source of income, and how to manage your money more wisely, right? So who's this course for? This is for everyone. You know, you can be a salaried professional, you can be a businesswoman or a businessman, or you can be a freelancer, a housewife. Basically anyone who is who has money and wants to invest wisely, wants to use it wisely. See, money has an intrinsic value of satisfaction, of bringing us happiness, right? So we have to make sure that the way we use money, or the way we spend money, brings happiness in our life, right? So about me, my name is Swapna Srivastava. I'm a chartered accountant plus FRM. I have almost 15 years of experience of working in banks and corporate treasuries, and I've handled investment portfolios of companies like Reliance Industries, Ford Motors, and so on. I've been into this profession for last 5 years, and I've been into, actively advising people as to how to manage the investment portfolio and how to make sure that the money, earns for them, as we all know the concept, right? My big promise that by the end of this slide, you'll have, by the end of this program, you'll have a game plan as to how to increase your overall wealth, and you'll be totally aware of the various investment avenues of how to use and invest your money smartly. Okay, you'll also get a complete clarity on how to manage your finances. I would also get free access to a collection of my articles that I've published over time. And you'll also get free access to some private Facebook groups that I've been managing, wherein you can post your queries and your questions, or any new investment products. If you come across somebody's pitching you across, you can, just post your queries, concerns, and I can also get back to, or you can have viewpoints of the other members as well. I would need your permission to take the last 10 minutes of yours to actually let you know what is a big promise in this whole webinar. By the end of webinar, you will be actually be able to understand the concepts, but you might need some more help. So just let me know in case it's fine with you. Maybe you can type yes to let me know that last 10 minutes we can use to have a more fruitful discussion about how to take this relationship forward. In the chat box, you can, write yes or no, whatever you want. All right. Okay, I can see few yes, so I'll just move forward. Okay. Now, based on my interactions with lots of people, individuals, over last 5 years, I have actually compiled a psychology of people who are into investing, who, want to save for their future, who want to save for their life goals. But there are certain apprehensions always there in your mind, you know, something like this: you're earning but you're not knowing what to do with your money. I mean, should I invest, should I spend, should I give it to my relatives, or should I buy a home? What to do with my money, right? I am saving but I'm not becoming wealthy because my investments are not giving me returns, right? So the basic problem, the basic disconnect with today's people is that they think that they are saving to become rich. That's absolutely not the case. You save to achieve your goals, and your goal is actually not, you cannot become rich by saving. You can become secured by saving, but you cannot become rich. For becoming rich, there are other avenues. You have to increase your source of income, right? And we'll also talk about it. But most of the people think that they'll become rich if they will save a lot, which is not the case, right? And there is that people are scared of investing in financial market. They think that, because there's lack of information, there's lack of clarity. We don't know which company is performing, which company is going downhills. We only get to know probably by the end when it's on the newspaper or probably on prime time news. So they're apprehensive, right? So that is one of the biggest concern which we see in today's times, right? That people are not aware. They're also apprehensive that what will happen, what if I lose my job. So they're apprehensive of getting into a long-term saving commitment, 10 years, 15 years, 25 years. And I have to say that if you're saving for long-term life, or saving for, let's say, retirement, or your life after retirement, then you have to have a long-term commitment. The biggest worry: what if I don't have enough money for my future? What if I outlive my savings, right? What if I'm not? What if my money is exhausted and I'm still alive? What if I don't have proper medical insurance and stuff like that? There are a lot of apprehensions in people's mind, and we're going to address everything in today's webinar. As you can see, the spending is very easy than saving. Saving is a mindset. Saving is a disciplined mindset. I would say that you have to follow certain rules of savings, and then you can make sure that you achieve your financial goals, right? And free yourself from financial worries, right? I will never say, no prudent person will ever say that you'll become rich by saving, but you will definitely be free of your worries if you save well. Okay. All right. So there are 3 secrets of securing financial future, which I'm going to share with all of you today. Again, these secrets are like all other secrets, are lying widespread in the world. So it's nothing like you'll say that, oh, I'm hearing it for the first time. There might be a few things which you might hear for the first time, but it is all about that I've compiled it, and I have decided to use it for the benefit of people at large. So the first secret is, having a financial ready reckoner. So whenever, let's say, you go to a place, let's say a zoo, right? And you're given a map, right? And you know that, okay, this is the area where I have to go. This is the time I have to spend in this area. These are the places where I can, spend more time with my kids. This is the benefit I'm going to get out of it. And then based on that map, you take a decision there itself, yes or no, whether you're going to the north wing of the zoo, whether you're going to the south wing, east wing of the zoo, whether you're going to tiger cage, or whether you're going to the elephant area. Based on that map, you take a decision, right? Based on the time you have, based on the energy levels you have, you take a decision. So financial ready reckoners are also like that. They're quick rules for you, to take decisions then and there, whether you should do it, whether you should not do it. Okay. Secret number 2 is the investment first budgeting method, which I've said I've developed it over time to help people achieve financial independence, right? If you stick to that model, you are never going to go haywire. You're always going to achieve your financial security. And step number 3 is having a plan B, and we'll talk more about it in slides to come. Okay. So financial ready director is something which probably top 10% of the people use religiously. You know, and this is a source which is, these are the formulas, these are the models which are developed over time based on people's psychology, based on the long-term spending patterns, right? So people think that that something has gone wrong, but they don't realize that they you know, they're not following that general spending, investing, or income generating formulas, right? So if you are in the larger bucket, you're going to make, you will not lose money. You'll probably not be making windfall gain, but you'll not lose money, right? Now if you're in amongst the outliers, that is, you're not using models but you're using your own financial wisdom, you might make a lot of money, a windfall gain, and you might end up losing drastically. So the risks are higher. Okay. So that is the point. I already said, these are the fine starting points which can help you make quick decisions, and you should keep them in mind while you're taking any sort of investing, buying, purchasing decisions, right? Secret number 1, 50-30-20 rule. Always remember, right? Whenever that's a basic thumb rule. What is 50-30-20? These are the percentages in which, these are 3 buckets in which you have to allocate your money. 50% to your expenses, monthly needs, daily needs, the needs that you have, you know, to survive. Your let's say rent, your electricity expenses, your kids' tuition fees, your you know, DTH subscription, and your phone bills, and your insurance bills, and so on. All these are there in 50%. Even the loan EMI that you're paying towards your house, if you're not, you know, if you're living in the same house for which you're paying EMI, that EMI should form part of your 50% expense. Okay. Just a minute. We have an intruder. Sorry for the disturbance, but that was my younger daughter just came back from school. Okay, so 50%, that's okay, Shelly, I'm managing. So maybe later on. Okay, so 50% is the amount of money that you need to allocate to your expense side, that to your need part. Okay, something that is very basic to your survival. 20% is the amount that you should save for your long-term life goals. Okay, like your retirement planning, like your child's education, like your let's say if you want to prepay your home loan, right, then that amount of money should form part of your 20% investment kitty. Okay, what is 30%? What is this 30%? Now 30% is a very tricky portion, right? This is something which brings happiness in your life, which you get, you know, while you spend money, while you upgrade, right? If you're going to a normal restaurant, maybe you go for a fine dining thing. If you are you know, going to a vacation near your hometown, maybe you can plan a vacation far away. If you've been having domestic vacations, you can plan an international vacation. So 30% money is actually for your short-term goals, right? Maybe an annual goal, or maybe something, you know, big family function which you are planning, and you can, you know, put your money in this bracket. But make sure that 50% goes towards, not more than 50% goes towards expenses. If it is, cut down your expenses. That's a you know, red flag for you. And 20% allocated for your long-term needs. If you think the 20% is not enough, then I will say that you need to increase your income sources, right? Because if you will start investing more, saving more, then you will be actually not living your life, which is also very important in today's times when we are working under so much of stress. We need to enjoy our life also. Okay. The second, secret formula is 110 minus your age. Now that is the amount of equity exposure that you should have at max, right? So let's say I'm 40 years. So 110 minus 40, that is 70. 70, my equity exposure in my portfolio should not be more than 70% at any point in time. If my mutual funds, which are again an equity exposure, have increased at 70% because of the profits, book your profits, put down your bring down your equity exposure to 70% and put that extra money in, let's say, debt instruments, maybe an FD, or maybe a debt fund, or maybe a long-term fixed income guarantee plan or something like that. But don't let your equity exposure exceed this formula, because this formula is built on the risk profile that you can take as per your age. It's very important. 30-day rule. Now this is for shopaholics, right? If your online buckets are filled with stuffs and you're always planning to purchasing more and buying something more, you're not able to pull yourself out of the stores. This is the 30-day magic rule for you. Therefore, your need for 30 days and reevaluate, revisit after 30 days. If you're still wanting that item, then I would say that you can go for it. If you're not, if you think that no, this style will not look so good on me after 30 days, that was an impulsive thing, and you will be able to get over with that. So there are a lot of such secret formulas which I can go on and on sharing with you, but maybe not all of them today. These are just the 3 golden rules, the topmost rules that I've shared with you. Keep that in mind whenever you are investing, spending, or making an investment. Okay. Let's come to our secret number 2, which is the 4 steps of investment first budgeting plan. What is that? Why do we need it? I have felt that the real reason of financial worries, the real reason of the insecurity people have, that what will happen to me in old age, or whether I'll be able to save enough, or whether I will be, or what am I doing with my money, is because they don't know the secret formula of this model, right? So I've modeled the entire working in this 4 steps, and I'm going to share this with you right now. Okay, so these are the 4 must-do activities, which any person who's involved into earning and saving money should do, right? The first step is create your own budget. Now, making budget is very important. You must have heard a lot of people talking about it, and you will be thinking that what's new in that? I would say there's nothing new in that. But this is the foremost thing. You have to know what you're earning and what you are spending, where you are spending, right? If you're going through that financial worry zone, okay, then develop your investment policy statement. Now this sounds very heavy, but this is something like a risk profile for you, right? You need to know that, okay, this is my age, this is my risk preferences. I want my money to grow at, let's say, 30%, or I am quite okay with my money making 15%, or no, I don't want 15%. I just want a good 7% return from FD. Okay, so what is your risk profile? What are the type of investment instruments you prefer? Whether you want to go for FDs, what type of FDs, whether bank FDs or private company FDs, whether you want to go for mutual funds. So which type of mutual funds? There are different type of mutual funds which give you different type of returns based on their risk indexes. Okay, so based on your risk profile, your preferred instruments for investment will be accordingly, should be accordingly chosen, right? And then obviously the investment horizon, that you're going to invest for 5 years, 10 years, 20 years, based on your life goals. Third, very important critical element which most of us Indians miss, and that is knowing our insurance coverage, right? Most of us, most of the people I have bet are either not insured or underinsured. right? And I have, and people think that, oh, I'm, I'm healthy, I'm okay, I spend a lot of money on my fitness, I don't need insurance. But then we all know that it's not just about health, it's not just about, going to gym daily or doing yoga. These days anything can happen to anyone, right? And then let's say insurance saves us from the uncertainty into the lives of people who are left behind. So very important and critical part of the entire investment plan, that you make sure that that you are insured adequately. Okay. And then the final step is creating and increasing your net worth, right? We'll talk more about what net worth is and how you're going to make that net worth statement of yours. Okay, so what is investment first budget method? As I said, why budget is important. Every company and every country, small or big, have their own budgets, right? So why shouldn't I have my own budget? Why should I not be in a situation to, track my income at one hand and track my expenses on one hand? And I should know that, boss, I had to spend only 50,000 rupees this month, but I have spent 55. So next month I have to spend 45 only. I have to make sure that I live within that bracket. Okay. Otherwise, my variances of expenses and my deficit into my investments will just go on. And at the end of maybe, let's say 3 or 5 years, if that unruly investment spending pattern go on, it will actually impact my total investment portfolio, the amount of money that I want to have for my post-retirement life. Okay. Every individual's risk and return profile is different. I might be wanting 15%. I'm okay with mutual funds which give me 15% returns. Somebody else might be investing heavily in bitcoins, right? So it all depends what type of risk you can take. Insurance is not a wasteful expenditure, guys. Please understand, adequate insurance is must, critical. And then you have to create your own financial life to achieve your goals. Create high net worth. Now, creating high net worth is the most important thing. How do I measure my net worth? Simple, again, a formula: 10% of your weight into of your age into, not your weight, 10% of your age into your annual income. That should be my net worth as of today. So, after this maybe webinar, just calculate whether you're near that item, whether you're exceeding it. Very good. If you're not, think about it, how to increase your net worth. Okay. This is a testimony from one of our clients who actually used this model of ours and was able to increase the savings substantially. She always used to say that, I don't have money to save. I'm just not able to save adequate money. And then we told her, we actually helped her to track her expenses and record her income. And so she was able to save well. Okay. Create your own budget. So knowing is always better, right? I mean, if you know your way, you're always confident. If you know what amount of salary you're getting into your account, it's always good. If you're knowing what is the amount of discount I'm getting, always good. Note down all your income and expenses. Even if you're getting a rupees 100 dividend from any of the share that you've invested, even if you're getting a minor, let's say annuity income from any of the investment that you did long back, record that income. Money counts, right? Each and every paisa counts. So you should know what are your sources of income, right? And you should also know that where you are spending. Remember the first rule: 50, 20, 30. You have to follow that rule. You can follow that rule only if you're noting down all your income and expenses. Let's say if you're not recording income, right? I have a small house, maybe, in my hometown, which I have rented out for 5,000 bucks, and I'm not recording it. Where is that money going? It's actually coming into my account and I'm just eating it away, right? So the point is that I should know what I'm getting in any form. Okay. Consolidate all your earning sources. Already talked about it. Track variances, very important, right? If you budgeted that I'm going to spend only 50% in this month, if you've spent more, please make sure that you are back on track. creating your own budget helps you to plan for all your, short-term events. Let's say I want to go on a vacation, or it's going to be my 10th anniversary, right? Or it's going to be my kid's first teen birthday, right? Whatever it is, and I want to make it a big event. I want to invite all my friends, relatives, and all. It's going to cost you money, right? So you can plan your short-term events with the help of your budget. Long-term financial goals, you're already aware of it, but you can also track your short-term events. Developing your investment policy, as I said, sounds big, but it's very simple. Make sure that it always make sure that what are your objectives, what is your risk tolerance, what amount of money you can lose on any bad day, and what is the money that you will need for your post-retirement days, or for your let's say kids education. You want to send your kid to foreign university, or you want to just support your kid because your kid wants to go to Mumbai and try out hands in acting, or some performance, and you need to have money to support your kid, right? So any sort of financial goal that you have. Tax is something which we all think that it's just 25% of the earn, if you are into that bracket, 30%, or things like that. But I would say that I should know what amount of tax I am giving. I should know that what is the tax obligation on all my income sources, right? Then only I would be able to file a fair return, take benefit of all the redemptions or the exemptions that are available to me, and would be able to make best use of the government policies that are available, right? The last point here is very important: monitor, right? You should not invest and forget about it. You should monitor it, not every day, maybe not even 6 months, but 6 months is you can do it. But if you're investing in mutual funds, nothing less than 3 years, you should not think of quitting. If you're investing in equity, you have to monitor it every 3 months, right? And if you're invested in fixed income, you really don't need to think about it. But if you're having exposure in equity market, you have to monitor your portfolio. And you have to make decisions to exit. Entry and exit timing is very important. This is something which I probably talk about it in later webinars, which I'm planning to schedule, not today. But entering into the market and exiting the market at the right time is the key to make money. There's again a financial thumb rules I'm going to share: 90-90-90. It's called 90% of the traders recover 90% of their money capital in first 90 days of their trading. So if you are not doing that, you are not making money as professional traders do. Okay, so we go to the next slide. Okay, now I'm going to give you some tips for healthy investment portfolio. You can, just think about it and maybe evaluate at your end. Most of us have a lot of money in our saving bank accounts. Apart from few of the banks, I think most of them give 2 to 3% return in savings bank, which is like nothing but peanuts. I suggest that you keep your saving bank funds into a liquid scheme of mutual fund. Any mutual fund you choose, SBI, HDFC, ICICI, all the liquid funds give minimum 7 to 8% return. And there is no exit charge in liquid funds, so your money is as good as you're keeping in your bank savings account. You can withdraw it anytime you need. So just maybe keep a month's expenses in your bank account and transfer rest of the money into your liquid fund. Whatever you are investing also in form of SIPs can go from the liquid funds. You can create a systematic transfer plan in the liquid fund itself. Okay. Instead of bank FDs, you can opt for FDs by NBFCs. They give much better returns. Let's say if ICICI these days is giving 6%, 6.5% on FDs. Most of the banks are cutting rates. NBFCs, on the other hand, give return as much as 9 to 9.5%. Okay, so there is a clear cut 2 to 3% increase in what I'm getting in form of return in FDs. But yes, there's always this rule, right? Higher the risk, higher the return. So while the FDs in banks are totally safe, 95% I would say safe. If you're investing in ICICI, HDFC or bank like SBI, if you're investing in bank like Ratnakar, yes, you're getting much better FD returns, but then the risk is much high. So you have to keep sure that you're updated. You keep your ears open at what is going in the market. If you hear some bad news, take out your money. Okay. Tax exemption limits. Most of the people think that tax exemption limit of 1.5 lakhs is a hard limit, right? And they don't need to invest after 1.5 lakhs. It's not like that, right? I firmly believe that government issues a lot of schemes and policies to get money from the public, and investing in those policies, those schemes is best from point of view of security, right? And if government is offering me money, why not take it? So I would say use all those avenues, invest in PPF, open a PPF account, get NSCs, get post office, invest in post office schemes. If you have daughters, invest in Sukanya Samriddhi. It's a very good product for daughters. And these are all, these investments should be for your long-term financial planning, because most of these investments are easy to enter but difficult to exit. So like in Sukanya Samriddhi, the lock-in period is 21 years till your daughter becomes 21 years or get married. Before 21 years, you're not able to withdraw money, but you're getting a handsome return of 8.5%. So, and plus if you stay invested, let's say for 15 years, 20 years, you're getting a benefit of compounding. It's huge, right? It's not a simple interest, it's a compounding interest thing here in all the government securities, and you actually end up making more money than the rate of interest which is given there. So make full use of these government schemes which come now and then, and if you have extra sum of money, keep investing. Okay. Another benefit is that the money in PPF, Sukanya Samriddhi and all, they cannot be attached by any legal agencies. Even if there is some recovery cases going against you, that money cannot be touched. Okay. You can also avail loans against these securities. All the banks accept FDs, national savings certificates, post office investment, post office schemes and all, as compared to your savings in equity shares, because the valuation differ a lot, right? So investment market for beginners, if you're still not invested, or if you do not want to take too much of risk, always invest in large cap blue chip funds, because maybe let's say the market is going down, the valuation of these large cap blue chip funds might also go down, the NAV might go down, but when the market rebounds, right, these funds will be the first to reach at the top, right? So the amount of money, the valuation of the money is safe with them. I mean, only if the economy is going to kaboot, India is going to be bankrupt, will these blue chip companies like SBI or HDFC or ONGC or Infosys, L&T or companies like that, they are going to lose money. Otherwise, long term, 20-25 years, at least in our lifetime, they are not going to be bankrupt. Okay, very critical point. Always keep track of mutual fund, your mutual fund portfolio's return from the benchmark return. So if you're, let's say, invested in large cap, always see that what Nifty 500 has given return in that span in time. Okay, if you're invested in some banking fund, then see that what banking index has given return in that point of time. So that's the way you compare the performance of the mutual fund schemes in which you have invested. Okay. If you want to take a direct exposure in those blue chip companies and not through mutual fund, instead of putting all your money at one go, you can always create stock SIPs. Okay. So if I want, let's say I want to have a stock of Maruti, right? So 6 months back or a year back, Maruti was trading at around 9,000 rupees. Okay, so if I have, let's say, a lakh of rupees, I would have got around about 10 shares, right? But if I create a stock SIP and every month I would be like, buying one stock of Maruti, my average buying price would be largely in line with Maruti's today's valuation. So I would not lose money, right? And when market rebounds, when not auto sector rebounds, Maruti will be the first to come up, right? So always create stock SIP if you are wanting to have a big exposure, even in large companies, because valuations are too big, and investing at one go, putting all your money behind in one company is not a good idea. Okay, when to wait for market correction for lump sum investment. So if you have, let's say, 50,000 rupees, I would say now is the right time to invest in any mutual fund, because markets are down, valuations are down, and you can put your lump sum money in the market at this point in time. When market is rising, never do a lump sum investment, always do a SIP, right? But SIP, you don't need to really time the market. You can enter the market at any time, because SIP, the modus operandi, the method behind SIP is to average out the buying price in a large span of time. So by SIP, investing through SIP, you always get the benefit of volatility, right? But by doing a lump sum investment, you're never going to get that benefit. So always wait for the market to go down. And if you think, for example, let's say Maruti, so right now it's trading at around 5,000. If you have been tracking that share, and if you think that 5,000 is a good level at which I can enter, now is the right time. Okay, but don't put your money at one go if you're doing a lump sum investment. Again, ULIPs. ULIPs are something which people have talked a lot, saying that it's not a good product. I would say ULIPs are a very good product as far as long-term investments are concerned. Right? It really gives good returns, because the more you're associated with ULIPs, you get bonus units. The charges now for ULIPs are as low as 1.25%, which actually matches the mutual fund charges. So I would say that ULIPs are great products. Don't combine insurance with investment. So ULIPs, you should take it as an investment product, not as an insurance product. It has an added benefit of insurance also. But if you're wanting to have a term insurance, which I said is very important, go for a pure term insurance policy. Okay. Equity exposure ideally should never be more than 70%. Assess your risk appetite and invest accordingly. And creating annuities through guaranteed income plans is very important these days, right? So what I've seen is that people keep on investing these days through SIPs, and they don't get that feeling of getting that income into the bank account back. So I would say that invest a little into guaranteed income funds also, wherein you will get money after some time. It starts coming into your account, and you can use that money in that 30% bracket where you were wanting to spend on your wants, not on needs, not on your long-term saving goals, but on your wants. So you can either use that money for your planning your short-term goals, or you can reinvest it, whatever is the situation. Consolidate your investments. So I see that people, you invest. Somebody said, okay, invest in this stock SIP, they've invested that. Somebody said that, okay, take this share, they've invested that. Then somebody said that, okay, let me put some money in RD or FD. So investment, it's scattered. So always, make a document, consolidate your investments, share that file with your spouse. One should know what are the login IDs, what are the, make sure that nominees are updated. Okay, that's very important. So all these things has to be very systematic. The Even the tax planning also doesn't need to be a year-end exercise. कि भाई February में, when we get a reminder from companies HR that this is the time to invest, give an investment declaration or proof of investment, then we say अच्छा ठीक है अभी हम NPS में करेंगे अभी. Not like that. You got to the investment exercise has to be, you know, throughout the year. It is a discipline, financial discipline. Like you go daily to gym, you go daily to yoga class, kids go daily to school. I have to daily, you know, get into that habit of investing. Monthly investment pattern is very important. Okay, this is a small slide which you can see. You can, you know, make sure that you are using all these tax exemption clauses which are available. Standard deduction is obviously available. ATC is 1,50,000. NPS additional, you can take benefit of 50,000. So 50,000 is also available in ATC, and you have to tell your employer that you're going to invest in NPS so that you know the employer creates that NPS bucket in ATC. And again, under 80D, which is a medical insurance for your parents, you can, you know, get exemptions on up to 75,000. And 24B is the interest on home loan that you bought. Make sure that you're making good use of all these tax exemption clauses. Okay. Right. So they said 50,000 approach, or you have to tell your employer. If you've not told your employer, you'll not be able to get that exemption. Instead of tax saving 5-year FDs, invest in PPFs or ELSS to save money. You know, ELSS definitely give us return up to 15 to 18%, whereas, and the lock-in period is also 3 years as compared to 5-year FDs, which is 5 years. Again, PPF has a longer lock-in period, but again, it's easy to enter, difficult to exit, and therefore money in PPF has to be for a long term, can be used for a long term life goal. Okay, gift money to your parents and you know, relatives to do further investments. So parents would be senior citizens, and if you're, you know, gifting money, it's not taxable. Any amount of money you can give to your parents, it will not be taxable, and they can do further investments in their name. And you can, you know, as a family, take benefit of all the tax slabs that are available. You can also save tax by gifting money to your minor kids. That's a little technical because it involves creation of a trust and then filing return in the name of the trust. But yes, this option is totally legal and totally available. You can save tax by gifting money to your minor kids. If you don't do that, then the earnings in the name of investments done for minor kids would be taxable in under your name. So know your insurance coverage, as I said, very critical. It's not wasteful. Don't think that it's wasteful. Get an adequate insurance. You must know what your insurance coverage is. Approximately 15 to 20 years of your annual income. It might differ, you know, depending on what is your earning age that is left. But ideally, it is 15 to 20 years of your annual income. So let's say if somebody is earning 25 lakhs, he or she needs to have a 5 crore term insurance plan to make sure that, you know, the family needs are taken care of in the same way as he or she would have taken care of. Last step is increasing your net worth. That's the final goal, you know, of doing all this exercise, creating budget and then investing wisely, and then you know, tracking in investment performance and stuff like that. It's the entire purpose of doing all this is so that I know what my net worth is, and I know how to increase my net worth, right? So it's the final goal. And I think that everyone should have that net worth statement. You can maybe just make it in a simple Excel, or you can have a flashy net worth statement, but it's basically your assets minus your liability. So it's net worth, right? You got to reduce your liabilities. Now, 2 ways to increase your net worth. You either increase your assets or your earnings, or you reduce your liabilities and expenditures, right? So So, this is something which you should do. Maybe an annual exercise. Both, husband and wife should get together, record all their assets, depreciating, non-depreciating, and record all the liabilities, all the loans that you have taken, and come up with a net worth. I told you 10% of your age into your annual income should be your net worth. Okay, this is few case studies which when I discussed few of the things with my clients, I've noted it down for your benefit. Mitali was one of a young girl who worked with me, and she wanted me to advise her as to how to increase her savings and then returns on her savings. So she was an IT professional and she was totally not aware of the financial products, very apprehensive investing in markets. So I told her that investing in ELSS is always a good option, because ELSS are quite well monitored, regulated products of mutual fund schemes. So it's absolutely safe than the normal mutual funds, right? So instead of going for a 5-year FD and maybe settling for 7-8% return, she can opt for better returns for ELSS. Plus, interest on FDs is taxable every year, right? Whatever interest you're earning, it's getting taxed, but ELSS returns are taxable as per normal mutual funds, and you're going to be taxed only if the return is more than a lakh, right? So that is one. So effectively, you end up earning almost 15 to 18% more than what you earn in a 5-year FD. Okay. Again, another couple with whom I worked, they were, both earning today's millennial generation couple, and they were earning a lot and were spending a lot, really not knowing where the money was going. So, again, were not very sure of taking exposure in equity. They were having SIPs, but very small SIPs. Together, they were earning almost a lakh as a couple, young couple, and they were not very sure. They were having SIPs of 1,000, 2,000, not more than that, and that too they were not knowing what type of SIPs, what type of funds they were investing in. So we created a budget plan for them, and we told them that they can increase their SIP exposure to, let's say, 5,000 per month, and they can track the performance so that their anxiety level would go down, and then after that they might increase the exposure. The main concept behind SIPs is that the earlier you start, the better it is. I mean, if you're starting early, let's say with Shruti and Amar, they were approximately 26, 27 years of age. If they started early, right? So they have, let's say, another 30 years to invest, and they would very easily get their financial goal of creating a 2 crore kitty for them. The next last secret is having a plan B. Now again, it is not a secret. It is something which everyone should have as a backup plan. It can be your hobby or passion which you have stopped pursuing because of lack of time, or you can so now is the time you pick up that hobby and passion and start investing in it. One hour a day, maybe that's enough. And you should always be in touch so that you can scale it up anytime you want, right? If you're deciding to quit your job, or if you're going on sabbatical or anything of that hobby and passion will help you generate a maybe not that level of income, but a steady source of income to keep your daily expenses covered, right? Part-time work, very important. So when I was doing my FRM a couple of years back, I also attended classroom sessions for I picked up books almost after 11 years, and I thought that going to class would be helpful. So there I saw that teachers were mostly less than 30 years of age, and they were freshly qualified from IITs or IIMs, and they were taking classes there, and most of them said that they love teaching, and that's what they're teaching in weekends, right? So it was a part-time job for them. They were making good money, and they were also pursuing their passion. So again, if you have that option of doing doing some part-time work, explore it and do it. Okay. Third point is, as you will see, what as Warren Buffett said, create investment source, right? So if you're investing wisely, if you're creating a portfolio which will give you a steady source of income, good for you. Okay. So that brings us to the end of today's session. Thank you so much for attending today's class.